Hello, good afternoon. So just a quick update from me. Obviously want to cover off the Silicon Valley Bank collapse that's happened over the last few days and what ultimately how that situation occurred and what that means moving forwards. Okay, so first thing that I really want to highlight is that SVB, okay, was the 16th biggest US bank with just over $200 billion in assets. Okay, now that's really, really key because unlike some of its counterparts, some other regional banks, the likes of JPMorgan, Bank of America, Citigroup, Wells Fargo, they weren't facing the same regulatory requirements as those kind of banks. And the reason for that is under the Trump administration back in 2018, they passed a bipartisan bill which redefined banks that were basically systemically important. And they raised the limit from 50 billion up to 250 billion for being US dollars for being systemically important. And so that 200 billion mark that SVB were in, they fell underneath that 250 billion mark, the requirement for that bill. And what that meant is, so under the new regulatory framework, certain banks were actually exempted from some of the strictest requirements that came out of the likes of the 2008 financial crisis, leaving this nice little air pocket that they've been sat in for some time, meaning that they're able to sort of move around and underneath the radar for some of the requirements and stress testing that's supposed to be done on these sorts of institutions. So one of the key revisions was that the Fed's decision to exempt banks with $100 billion to $250 billion worth of assets from maintaining standardized liquidity coverage ratios. Okay, so as long as they kept their short-term wholesale funding levels below a certain amount, okay, they weren't being tested. Now, this was all part of a really long, drawn-out national debate following the 2008 crisis about which banks should be more regulated aggressively and how they were going to do that. So banks below the $250 billion asset size would be exempted from Fed's annual stress tests, okay, and SVB and some of the other regional banks actually lobbied towards that change. And so actually banks with 100 billion to 250 billion range were only required to undergo the stress testing every 2 years. Okay, and that's how comes we've started to see this situation occur. You know, the place that we find ourselves in now is all occurred in under a 2-year period. Okay, high inflation, interest rates going up. We're in a place that the last stress test that they went under, they would have flown under the radar for. Okay, so what really does that mean? Okay, so the Fed has actually stepped in. Okay, they've said they're going to support the customers for those for SVB. And initially, when it occurred, you know, the markets wobbled a little bit, but actually they've now seen that, you know, the Federal Reserve backing a bank like that means that the banks, you know, are they now too big to fail? And so, you know, the Fed now needs to look at whether they continue to put up their interest rates despite high inflation, if they're going to be as aggressive with it. And some of the things that we need to look out for is the February report for CPI, which is out today. Okay, and it's expected to show some prices cooling off, and which means that maybe the Fed's only going to go with a 0.25 rate. If you speak to Goldman Sachs thinks they're actually going to abandon a rate increase altogether in light of what's happened with SVB. And so, you know, we really just need to make sure that we're spreading risk as much as possible. We don't need overexposure to any particular sector, and the key is really just to remain diversified as much as possible. The chances either way of it happening, well, 80% chance that it's a 0.25 increase, There's a 25%-ish chance that it's a 0.5 increase. There's also a chance that there's no increase. Okay, so we just need to watch really carefully. Expect the markets to be volatile today as the data comes out. Pre-market looks good, but that can all change in a minute. And so just really, I cannot highlight to you enough, you know, if we've not spoken, we need to get together. We need to talk about diversifying, or we need to review your portfolio and see if we can protect you a bit more against market volatility. Likewise, you might be in the mood to take advantage of it. Speak to me. Let's try and get something in the diary, and I look forward to hearing from you soon. Any questions, just let me know. Thank you.